We'll learn about government spending, maybe some facts that you've already learned about the government through some social studies classes. You should already know that we do have three levels of government: local, state, and federal. We're going to be primarily dealing with the federal level. And that we have three categories where our government spends money: the purchases of goods and services, transfer payments, and interest payments. How does the government spend money? Well, the government is a big purchaser of goods and services. Not only do they purchase labor from people that work for the government, but they also purchase a lot of consumables, and they account for about 1/3 of our GDP. They purchase things such as equipment, materials for our national defense. They also take care of our parks, highways, and buildings, so they purchase items for that. They purchase labor and upkeep. Here is a chart that shows the government spending as of 2004, and I'll try to find something a little bit more close to our time period for class. But you can see even in 2004 that Social Security had the biggest percentage of spending, and national defense was right behind that. Here is one that I found that's a little bit closer to our time period, which still shows Social Security at the top with almost 19%, and then the Department of Defense at 16%. Notice that unemployment is in third place with 13%, and that would be due to so many unemployment claims since the recession of 2008. Transfer payment is a term that you definitely want to know the definition and what it means. When the government transfers payments, it is for nothing in return. So those people that receive Social Security benefits every month, those people that receive Medicare benefits, payments to their doctors, payments for prescriptions, for health benefits, unemployment compensation, and then federal grants, those money that does not require repayment, those are transfer payments. The government is getting nothing back in return, and this is the largest category of spending that our federal government spends. Social Security being the largest national federal program, it provides employment or retirement benefits and medical insurance, and this number continues to grow because people are living longer. And so the money that we are paying out in Social Security is the largest it's ever been. Interest payments. Because the government has sold many bonds, treasuries to citizens, the government has to pay interest on those bonds. And in the movie that we saw, the clip that we saw of IOUSA, it's predicted in the next few years that those interest payments will be a very large percentage of our spending and our national debt. So if you or anyone in your family has bought a bond, a government bond, the government must pay them the percent that's due. Now, as of 2004, 7% of our government spending was on interest payments, up from 1980 when interest payments made only 2% of government spending. So that number continues to rise as our government continues to borrow money in the form of bonds to United States citizens. How does the government get money? Well, through taxes. So as we are all taxed, as we work and pay taxes, that's how the government gets money to, buy tanks, to service roads, to pay their employees. Over half of all the government revenue that comes in is from individual and corporate income taxes. Most of the rest of the money comes from Social Security taxes that we pay from the time of our first job. For the most part, everybody that works pays some type of federal taxes that's deducted from your paycheck. So here's a breakdown, and this is from your book, and it's from 2004, so it is a little bit dated, but this shows a breakdown of where the federal government gets money from. So 43% are from individual income taxes, 10% from corporation taxes, and then we have 39% that come from Social Security payments that are made also from people's paychecks. And then we have excise taxes at around 4%, and we'll discuss what those are and why we have excise taxes. Another part of tax, again, comes from excise, and this is a tax that is on a specific type of purchase. So we have excise taxes on tobacco. We have an excise tax on gasoline, and we also have some on telephone services. Many states also have income taxes. We do in Indiana. Our income rate of taxes is 3.4%. We also pay sales tax at 7%, and we pay property taxes, which is based on the value of our home. Those property taxes, a lot of that, percentage of that goes to fund schools, to pay for schools, to pay for salaries, and that comes back to the community. And we also pay tax on stocks and bonds that we hold and other personal property. Here is two principles by which we justify taxes in this country. The first is just the principle of benefits received, which this means that a tax is directly linked to a benefit that you're going to receive. So by paying a gas tax, that helps pay for building and maintaining roads that each of us get to use on a daily basis. So we're receiving some benefit from that tax. The second principle is your ability to pay. So this idea comes from the more that we make, the more that we pay. So it says a tax is considered fair if two similar individuals pay similar taxes. And a deduction in tax, which your parents should get for having children, is a reduction in taxes. So there are deductions that come out of our federal taxes, and these principles show how taxes are justified in the United States. Here's an example of how much income taxes that you will pay, and this is a kind of a vague chart because it does not take into consideration anything other than a single individual in 2005. So if your taxable income is between $29,000 and $71,000, then you're going to pay $4,000 plus 25% of the excess over that amount. So we'll talk a little bit more about this in class. We'll actually do a couple problems on federal taxes and how we figure that. There are three types of taxes, and you need to know and understand the definitions for each of them. A progressive tax takes a larger percentage of your income from a high income group. So this is the principle of the more you make, the more you pay. And the federal income tax is an example of a progressive tax. The regressive tax requires that everyone pays the same rate. It's called regressive. Sales tax is regressive because if you are someone in a poverty level, you still pay the same amount as someone that is in a high income area. So let's say someone that made $30,000 compared to someone that makes $100,000. The person that makes $30,000 is still paying 7% sales tax on all their purchases, and that ends up being a greater percentage of their income because they don't make that much money. For someone that makes $100,000 a year, a 7% sales tax is not that big of a deal because it's not that great of percentage of their income compared to someone in the poverty level. So sales tax is an example of regressive tax. Proportional tax takes the same percentage of income from everybody. So Social Security is a flat rate of 6.2% of the first $90,000. So that's proportional, the same proportion from everybody, no matter how much you make, up to 90%. Here's an example from your book, and you'll want to look at this and discuss and understand these different types of taxes. We pay taxes on inheritance. So if you were to inherit some money from a family member or property from a family member, you're going to pay taxes on that. If you are given a gift from someone and it's large enough over a certain amount of money, the federal government is also going to ask for taxes from that. The difference between a gift tax and inheritance tax, an inheritance tax would be after someone is deceased. A gift tax would be while the person is still living, they're just giving you a gift. But because it is considered income, you do have to pay federal taxes on it. Lesson 3 is about creating a budget. And we probably know a little bit about creating a budget as a family, and you should have learned something about this in personal finance. But we're primarily going to be looking at the federal government and how they come up with a budget. So in families, we have two types of expenses. We have those fixed expenses that occur on a regular monthly basis, mortgage payments, rents, car payments, those things that are fixed and we cannot change the amount. And then we have discretionary spending, and that's the money that we get to make decisions on. Our federal government also has discretionary spending that they get to make choices, and Congress decides how that money is going to be spent. So in the federal government, we have two types of government spending. We just changed the name a little bit. We have mandatory spending, and we have discretionary spending. Mandatory spending is required by law. That would be Social Security. That would be Medicare. That would be interest on our debt, interest on bonds that people have purchased. That comprises 2/3 of our federal budget. So we only have 1/3 of our federal budget that is discretionary spending. And in order to spend this money, it must be approved by Congress. The president does not have the power to just spend the government's money as they wish. So those discretionary spending is broken down into defense, international, and domestic. And this also includes money that we need to pay for work to the government, such as the salary of the president and Congress. Here is a little bit about the federal budget process. So the federal government is not on the calendar year such as we know it. So the end of the year does not end on December 31st. The fiscal budget for the federal government starts on October 1st, and it ends at the end of September. So around February through September, Congress and the Office of Management and Budget starts working on a new budget for the next year. Hopefully somewhere between January through September, they're starting to pass a budget. So they would be in the midst of that right now, discussing the budget so that they can come up with a new budget that gets approved prior to a new fiscal year on October 1. Now, we've talked a little bit about deficits when we watched the clip from IOUSA, but the government is just like you and I. They do not have unlimited money, so they have to make decisions that are affected by scarcity, because remember, scarcity wouldn't be a problem if there were unlimited goods and services to go around, but that's not the case. So budget decisions are based on events that happen, such as the Iraq War in September 11th, 2010. We have to make decisions based on those events that we're funding. The definition of a surplus, which was in your reading guide, when the government takes in more money than they spent, that would be a surplus. When they take in less money than they spend, that would be a deficit. And if you remember from the video, we have been running a deficit in this country as far as budget is concerned since the 1980s. So we are spending more money than we bring in. What does a deficit do? Well, if you don't have enough money to pay your bills, and certainly those mandatory payments, then you have to borrow money. And when our government borrows money, it adds to the national debt. And the national debt is the total amount that our government owes. What are the pros of a deficit? Well, if we don't run a deficit and we don't borrow money, then our economy can't recover. We can't increase demand, and we can't create jobs. However, the negatives of running a deficit is that government borrowing always raises interest rates that you and I have to pay. It increases the cost for us as consumers of car loans and mortgage payments. And it limits the government's ability to create new programs that might be needed in certain areas. So when we're always running at a deficit, we don't have a lot of choices about new things that we can fund. So remember, I said in class, there are two ways to fix this. We can either raise taxes or we can cut spending. But if we continue to run at a deficit year after year after year, our government is going to find themselves in a position where the national debt is going to be totally out of control and will not be payable. And we'll talk more